In an earlier video, we looked at Dick Smith's in crisis, and that was in January 2016. They came out and announced that they were in voluntary administration. And what that meant was they had a very high level of debt. Their gearing ratio was 67%, and they had very poor liquidity. Their working capital ratio was only 1.23. And all this added up to the fact that they're not sure whether they can even pay their bills in the next month. So they've hired a special type of an accountant called an administrator, who's going to try and see them through this period, but there's no guarantee that they're going to survive. And then we saw the impact on the share price over the last few months is some people have seen this coming. However, people have still been buying these shares, so some people clearly didn't see it coming or thought maybe it was going to get better and they bought a bargain. However, shares are now halted, which means you can't buy shares of Dick Smith's on the stock exchange, and that happens automatically as soon as you go into administration. So one of the things we looked at in the earlier video was that Dick Smith's is a public company on the Australian Stock Exchange, and that means that any material information that they think will influence any decision making by anybody, any of their stakeholders, needs to be announced to the public. And that was all part of relevance. So if it's going to influence decision making, it has to be reported or produced or published. And in particular, the materiality test, if something's big enough to influence someone's decision making, or if you forgot that information or misstated it, it would result in a bad decision, that means that bit of info is actually relevant. So we saw you can go and get all these announcements every day that they're announced to put automatically on the stock exchange under the announcement section. And the people that need this info are shareholders, potential shareholders, banks, suppliers, the government, employees, customers, and there's a whole bunch of others that aren't on that list as well. But these people are all making decisions based on the fact that Dick Smith's is publishing material information, the fact that their shares are being halted for trade, and that there's an administrator. That would really impact these three groups here. First of all, shareholders can't sell their shares. Potential shareholders can't buy any shares because there's a trading halt. And the banks and the lenders, well, they're the people that Dick Smith owes money to, and at the moment they're saying, we're not sure we can pay you back. So this is really important information. So let's have a look at maybe a step back and figure out, where did this come from? Was there an earlier warning sign than yesterday? And we did look at some financial ratios, but now we're going to look at their inventory, and in particular their budgeting. So one thing that companies do is they prepare a budgeted profit quite regularly, and it's actually called a guidance report. So we do budgeting in Year 12 accounting. What we realized with a budget was we don't wait until the end of the year and then figure out our profit and announce to everybody our profit was $90 million. What companies do in the real world, and what small businesses do as well, is they make a budget. Now it can be as frequent as they like, but big business tends to do it every quarter, and that helps people make decisions. So rather than have the year as one big non-broken down group where we just report afterwards, they actually split it up into quarters, and each quarter they give a budgeted guidance or budgeted profit, which they call a guidance report, as to what they think their profits will be. So in January they might say, in 2015 we think our profit would be $90 million. Then they update it as they get better information and the year gets older to 70, and then they update it again. We had a good trading period, 100 million, and by October we're going to be a little more accurate at this point because we've already got 9 months of data, but we think our profit will be $80 million. Not it will be, we think it will be, and that's called a budget. However, why do these companies give you guidance when really it's a guess and it's not going to be 100% accurate? Well, we look at relevance versus reliability in accounting. So relevance means we need information to make good decisions, so we'd like some guidance as to what our profit's going to be. But reliability says information is reliable and should only be included if it's free of opinions and estimates, and it can be checked or verified with the source document. Now clearly, a guided budget or guidance or budgeted profit report isn't reliable. It's an opinion or estimate, and it can't really be checked with any sort of source document. So why do we do it? Well, one thing that companies do to get around that is they try and provide a range of guidance. So what they might say is at the start, rather than we think our profit will be 90 million, we think it'll be somewhere between 80 to 100. And then as we go, we're always providing a range. So we think profit is 60 to 80, and by July we thought it would be 90 to 110, and by October 70 to 90 million. So providing a range generally helps sort of find that balance between a number that's going to help us make decisions, so that's relevant, and a number that ultimately will be pretty reliable and pretty accurate. And that number that is published, people then make a whole bunch of decisions on that. So depending on what sort of stakeholder you are, you're going to be making decisions based on that most recent guidance report. So let's look at Dick Smith's guidance, not for the whole year, let's just look at the most recent ones. In the middle of the year, they came out and said, we think profit will be somewhere between 45 to 48 million. Then in October, they said, we think our profit will only be 37 to 43 million. So obviously there was some poor trading between those two figures, and they said, well, we're still going to make a profit, it's just going to be a little bit less than we thought. However, in November, there was a special material announcement made on the 30th, and that was published on the stock exchange. So you can see it there, and it says non-cash adjustment following inventory review. So that had a whole bunch of info in it. It said management has initiated a review of inventory. Stock holdings remain above management's preferred levels. We remain cautious on the outlook for the Christmas trading period. We will continue to drive sales, maintaining flexibility on gross margin to reduce inventory. A non-cash impairment of $60 million is required. And lastly, the company is unable to reaffirm the profit guidance previously provided. So there's some really good information there, but what we want to ask ourselves is, looking at all those statements together, does it achieve understandability? It's one of our qualitative characteristics. So information is understandable if users can comprehend its meaning easily. We can assume a reasonable knowledge of business and economics. So looking at that, given Year 12 accounting knowledge, we can probably interpret some of it, but not all of it. So let's try and convert it into language we might understand. Let's start with that first point. Management has initiated a review of inventory. In plain language, that means we've got a bunch of old stock sitting there for ages that we just couldn't sell. Stock holdings remain above management's preferred levels. And what that means is we've got way more stock left over than we thought we would have this close to Christmas. Remember, this is only a month out from Christmas. You'd start to think you're getting lower on stock rather than having more of it. We remain cautious on the outlook for the Christmas trading period. Well, that means Christmas sales will be much lower than we thought they would be. We will continue to drive sales, maintain flexibility on gross margin to reduce inventory. This is the one that's probably the most important, because what that says is, to sell all this old stock that no one wants, we're going to lower the price, and if we have to, we'll even sell it below cost. That's how badly they need to get rid of this stock. A non-cash impairment of $60 million is required. That simply means the old stock we had is now worth $60 million less than we bought it for. It's actually below. You can't sell this stock for more than it cost, which is the worst possible case scenario for a retailer. You're going to make a loss on every sale. And lastly, the company is unable to reaffirm the profit guidance previously provided. Fundamentally, that means our last profit guidance was 37 to 43 million. That's now going to decrease at least 60 million with the stock write-down. And basically, we can't say whether we're even going to make a profit this year, so we're not even going to give a number. Giving a number would be totally unreliable. I know it's not good for decision making, but fundamentally, we're not even sure what the number will be. So, if we're just looking at that chain of events again, profit guidance in the middle of the year was 45 to 48 million. Then it went down a little bit, the 37 to 43. Then we had this special material announcement about the stock impairment, non-cash impairment. And we can see the impact that had on the share price. It's been a downward trend anyway. But the day that that was announced, you can see, is at the end of November. And the shares actually crashed 70% in one day. So clearly this is material to decision making. A lot of people said, we don't want these Dick Smith shares anymore. We'll sell them at whatever we can get for them. So in December, just like they said they would, Dick Smith tried to sell all that old stock at heavily reduced prices. They had some ads out, had some junk mail catalogs going out. They had managed to get articles in the newspaper, as you can see on the screen. And the article here just mentions some figures. Dick Smith is offering discounts of up to 60% on smartphones, tablets, fitness, toys, GPS and printers, and up to 70% on TVs, Blu-ray players and audio equipment. So you can see this is current stuff that they'd like to be able to sell, like smartphones and tablets, but they just can't get rid of it. Maybe they're bad at selling, nobody wants to shop there, but the point is they're going to have to lower the cost in order to get rid of it before Christmas. Dick Smith has kicked off its mammoth clearance fire sale, offering discounts of up to 80% off unwanted stock in what rival retailer Jerry Harvey earlier this week described as a suicidal move. So Jerry Harvey owns Harvey Norman. He started it and now owns a significant portion of it, and he's considered to be one of Australia's smartest retailers, if not the best we have. So he's saying this is it's good to sell stuff, but if we're going to sell it at up to 80% off, that's basically a downward spiral and a suicidal move. So Mr. Harvey said they are not making any money if they sell everything in a fire sale. In fact, they'll lose a lot of money. Why would they do that? That's committing suicide. So what does the $60 million non-cash impairment mean? Well, it means the stock could only be sold for less than its cost, by about $60 million. And in Year 12 accounting, we learn about a rule called stock should be valued at the lower of its cost or its net realizable value. So net realizable value simply meant how much do we think we could sell it for, less any selling, marketing and distribution costs. So just making up some numbers here, maybe they're assuming that that stock that they had cost $400 million, but they think they can only sell it for about $340 million. Well, what you've got there is a stock write-down of $60 million, and that's actually an expense. So how do we record that? We do that in our general journal. So again, we're just assuming and pretending that they had $400 million of stock in stock control. Okay, just for the sake of the example. But what we would do is we record a debit to the expense called stock write-down of $60 million, and then we would decrease stock control by $60 million as well. So if we were to balance out this ledger here, we'd end up with a balance of $340 million, and it has gone down 60. So an expense has gone up by $60 million, and an asset has gone down by $60 million. So recording that stock write-down expense, we had our first guidance, our second guidance, and then our $60 million stock write-down. Why did we do that before we even sold the stock? So remember, Dick Smith announced this in November, and they did survive for another month or so. So why would they announce that before they'd even sold that old stock? Well, it comes down to the accounting principle of conservatism. That says caution must be used when preparing financial reports. Specifically, losses must be recorded when they are expected to occur. Why do we do that? We do it for two reasons. One, so assets and revenues are not overstated. Well, what asset were we talking about? Stock control. We're making sure it's not too high or overstated by decreasing it by $60 million. And secondly, we also be conservative and apply caution, so liabilities and expenses are not understated or too low. So what expense? Well, stock write-down. We made sure that it went up, and that means that our expenses aren't understated. So a big real-world example, but lots of things we can apply to Year 12 accounting. So not just practical stuff, such as the law of cost and net realizable value, but a lot of theoretical things like conservatism, relevance, reliability, and so on.